every risk we're talking about, whether it's inflation, whether it's the Fed, whether it's Russia and the war and China lockdowns, we're talking about it a lot. And I would think with the market down as much as it is, that a lot of that is factored in. So, what's it going to come down to? Fundamentals, right? And the Fed, when they raise enough and we see inflation moderate, and that could be 6 months from now, right? That's when you see the Fed does have a little bit of ammo where they could lower rates to try to stimulate the economy, whatever, which would be easier once we see inflation moderate, which we're seeing across the board. We're seeing across all these industries now, even housing. You're seeing home prices, not in certain places, it's through the roof, but you're seeing, with the prices going higher, the cure for higher prices, and basically you're going to see, and you're seeing it right now, where more inventory, right? That was the big thing. There's not enough inventory in the market. Now you see more inventory in the market, right? So you're seeing it in used cars, 3 straight months. You're seeing in a decline in prices, which is a small decline, but you're seeing it. So, even in other areas of the market that I've been covering. So you're seeing it a lot where it's, companies aren't going to have the type of pricing power. They continue to raise prices forever. However, this is going to be of the next 6 months is what companies could manage this the best. And that's what we want to go to, right? Because right now with the market really collapsing and losing that growth multiple that we were so used to having, which is well above 18 times, 19, 20 times forward earnings. You got to 23, 24, which is fine because we were growing tremendously and interest rates are low. That's not the case anymore. But now we're trading below 18, 17 times forward earnings. And there's a lot of stocks that are attractive right now, especially when you see the Apples, Googles, Netflix, Meta, Amazon, Nvidia. These companies just in the past few trading days lost $1 trillion in market cap. $1 trillion in market cap. You know how much that is? It's not funny, but it's $1 trillion. We throw around trillions like nothing. Remember when billions was a big number, trillion, and it's just past couple days. So now you have, a lot of companies that look attractive here, and that's what you want to look at. Like what companies are managing the best through supply chain concerns, are growing, and have come down, have got punished with everybody else. And I think you can find a lot of names, right?
Oh, absolutely. And that's the thing. This is just the gray area of investing. We don't know market bottoms or what exactly stocks are going to do. Nobody has a crystal ball. And so you could point to like Boise Cascade and housing wood materials and things. We've talked about that a couple different times. They reported earnings. And if you have a chart, BCC is I don't know if you're showing your screen there, Frank, to put you on the spot. But it's important to think and remember, as crazy as stocks can go down, GoodRx, Peloton, and Upstart are down, 30 to 60% today or yesterday, Frank?
60, yeah. Holy cow.
In a day.
Upstart, has got nailed. So, a lot of these names that miss are going down 20, 30%, like Peloton. Peloton, 30%, it was below $10, right? So, and they warned. So, and here's a chart of Boise Cascade Company, which is, you look at the 1 year, it's up 1%. Year to date, it's up 7.5%. It's a company trading at a P of forward P of 5 here, right? And just getting it done. But these are the companies you're going to find in a bear market where a lot of shit just gets unfairly punished. And, there's a lot of diamonds in the rough right now, right? Because more things are going to get attractive. Not everything. I wouldn't be buying Peloton here, which still has a $3.5 billion valuation, who's reporting massive losses, who had recalls on their treadmill. They're seeing subscriptions barely grow 1% year over year, and that's their bread and butter. It's still trading over 3.5 times sales. So, when I look at a company like that, I don't see the bottom yet. I don't see the bottom in a lot of the SPAC deals that we saw. But, when we're looking at this, there are lots of names that look attractive right here, which, we can cover right now. That there are one of the names that you just gave. So,
yeah. And one other thing I wanted to point out for investors looking around, because it's, typically you don't want to do the easiest thing. If it's easy, it's not worth doing, is an old fun saying. What's the easiest thing to do right now with the markets, Frank? Turn it off.
Yeah.
Sell and turn it off. Like, hey, don't look. Hey, what are you down? I don't know. I'm not going to look. That's not all bad, actually, at some point. But with Boise Cascade, and for people looking when you have these massive washouts, because it doesn't matter if you report great news or announce anything, when markets are acting like they have at the end of last week and the start of this week, everything's going to get thrown out with the bathwater. Mm-hmm. Look at AutoZone, AZO stock has been pulled back as well. But one thing you can look for, you can screen for, Boise Cascade has got a history of paying special dividends, because all the companies that were benefiting from this pull through and demand on, in this particular case, housing and people moving and things like that, and causing supply chain issues and price hikes across materials, look for companies that have paid special dividends in the past. You're going to figure out what management teams are really rewarding shareholders during rough times. And yes, and I'm not making excuses here. I'm not saying my positions aren't down. It's frustrating. it makes you scratch your head and wonder, why in the hell did I come work for Frank and do this? It's got to be a lot less stressful stuff we could do, Frank. But kidding aside, who is actually, markets go on. The sun's going to come up tomorrow. So that's why you don't want to get annihilated. You don't want to have massive losses. And you can look and see who is rewarding shareholders, because when it subsides a little bit, money, when you don't have a Fed stepping in to bail out everybody in terms of liquidity and causing a whole rising tide to lift all boats, when buyers and individuals are going to be finding a market bottom and then reversing at some point, and don't get too bearish just because it's easier to get bearish as things get worse. That's just human nature. Mm-hmm. You want to look for, when those decisions are being made, okay, now without the Fed stepping in, people are going to pay a lot more closer attention to where they deploy their capital. And you want to focus on companies that are rewarding shareholders either through special dividends, supplemental dividends, however they describe it. But Boise Cascade is one. AutoZone is another one I would put up there, not in terms of the special dividends as much, but just as the business plan rewarding shareholders through share buybacks and things like that. When you have massive, great companies that have amazing results on returns on capital and things like that, getting sold off with everything else, that's when you at least want to start nibbling away, and just use small position sizes. If you got to buy something now, just scale in, because if this market's taught you anything, you can add to a half a position in a week and be down another 25%. That's the reality we're in right now.
And when you start with a small position, you don't, not that you don't care if it goes down, but you're going to be more pissed if it goes up because you have such a small position. But if it goes down, it's almost like you're rooting for that because you're able to buy more and lower your cost basis at these levels. And I may be saying that for a lot of other stocks that are down and you lower, now you have full position. You're still down 20% on it, but it's much better than being down 70%, which seems like it's crazy, 70%. By the way, I saw an interesting stat. In healthcare, the average stock in healthcare, look, the average stock, I'm not cherry picking here, the average stock is down 75% from their high, from the 52-week high. 75% in healthcare. Obviously, that includes biotech as well. It's got annihilated. Some of these names are still going to get funded, and, they have cash on the balance sheets. Again, a good place to look. Another name that I like is Mattel. Just reported great results. They said, hey, we may be looking to sell ourselves now. The turnaround's complete. 17 times forward earnings, which is a market multiple, little bit discount, growing like crazy. Just, so many catalysts. It just reported in the same quarter. But, people ask me, hey, what am I doing in this market? What should I do? And like you said, Daniel, the easy thing is to sell. But I'm going to bring something up right now because I did a quick screen to see S&P 500 companies and how many are trading below 10 times forward earnings right now. And my screen, and I'll bring it up, yielded over 80 companies. So 17%, about 17% are trading. So if you're on a YouTube page, I can go over, you can see a lot of these, but I'm just going to highlight. And, stop me because I know you know a lot of these names. Wells Fargo, Bristol Myers, Freeport, Fox Corporation, Truist Financial, Valero Energy, United Airlines, FedEx, Phillips 66, Chevron, Verizon, Seagate Technology, Skyworks, a lot of leaders, right? HP, MetLife, Delta, Exxon, State Street, Goldman, AT&T, Pfizer, Whirlpool, a lot of great names there.
Sorry to interrupt. Did you say Exxon? ExxonMobil's trading for under a 10.
Most energy companies are trading.
Yeah, see that, and if you look at that's a good. Sorry to interrupt you, but you pull up a stock. Emotionally, it's going to be easy to not buy that because you already missed it. But when you actually put the fundamentals over that, think about that. So just like a stock can drop 80% and still be expensive, a stock can rise 100% or double and still be cheap.
Earnings, those earnings are incredible. And now what do you do, right? So I see these companies. What's the next step now? So when I look at this next step, I'm like, okay, what should we do here? And when I look, I'm like, okay, well, let me see how fast their earnings are growing. Obviously, they're going pretty fast at 10 times forward earnings, but do they pay a dividend? We don't Exxon, huge dividend. A lot of those companies do. Are you seeing insider buying? That's important, right? Insiders are stepping up. I'm sure you could find it. It's some insiders. Are they buying back stock? So I put all these factors in, you probably get a list of 5 to 10 stocks with all those quality. And that is really, really attractive because I'm like, okay, those are names that I could buy. It has all those qualities. It has a dividend for a little bit of safety, it has the buyback. Okay, I have some buying coming in a market where it's tough to get buying. Again, that dividend is more of a safety quality, and you want to invest where you're kind of protecting yourself here. You don't just want to say, okay, I'm investing in the highest growth stock and hopefully the market comes back and they're going to go up the most. But, you're looking at, has anything changed with agriculture? And fertilizer companies, absolutely not. Massive shortage, right? So we're seeing that. And we had Mosaic go down. I saw, 10-12% from its highs. Alcoa, that market's great. I understand China's offline right now, but Alcoa, those numbers were fantastic. That stock was at 90. It went to 55, 60. We're still up on it. We added to our position in our newsletter. And when I look at names like that, it's always providing a chance for you. Right now, it's like, hey, I missed it, right? You want to buy the dip. When you don't buy the dip, you miss it. Now you're seeing these stocks where if you miss it, you can almost be a little bit patient here too, and they're going to come down along with the market when you have these conditions. But it's hard to reverse that psychology because you want to see some kind of good sentiment. You're not really seeing it. A lot of great names reported great earnings are down. Even, Microsoft and Google by far reported the best earnings of the FANG names, and even those have gotten crushed. I understand why Amazon got crushed. I understand why Netflix got crushed. I get it. I understand Meta. But, when I look at those two names that, 2 quarters in a row, great numbers, wow, and they're still getting nailed. So there's a lot of names out there that are getting nailed in this market as we deleverage. I think we're pretty close there. I mean, this is a massive correction, but there's a lot of good stuff out there. And remember, if you're going to make money in this market, the people who make the most money invest in things when they're cheaper. And look at a 24-month time horizon. Think of Buffett. Think of anybody. Long-term investors. They don't invest when things are at the top of the market. They invest when things are very, very cheap. And right now, there's a lot of cash on the sidelines. There's private equity. Their balance sheets are full of cash. When you look at S&P 500 companies, especially large ones, where they're going to be using it to buy back stock, raise their dividend, but also now they can acquire a lot of these companies that are upstart. Are you kidding me? Not that anyone's going to acquire it, and I don't know the fundamentals too much, but I'm looking at a stock. What was it trading at, Daniel? 300 and what?
I think it hit 400 actually. UPST is the symbol. I think it hit 4, and then it's just been because we highlighted it a couple times, never as a formal recommendation, but it was a huge player, and it's a great idea, and it is profitable. I don't know about every year, but it's quarterly because it's a fairly newer stock. But great idea, but it's just it got caught up in the high.
It was down 60%.
Yeah,
in
a day.
For 30.
Yeah.
Right? Holy shit. Like, I mean, some of these names are just are getting whacked, but you have to be careful. Growth is not there anymore. We don't have a growth environment. I know people are used to growth, and it was a growth environment for 12 straight years, growth over value, killing it. And every value stock, even if you had to see growth in it. Now this is a value market with companies that are growing, but you need to see the value. You need to see these things be cheaper, generating cash flow, earnings, good management teams, which is, very, very important. And let's see if we see that going forward. But man, holy cow. I mean, some of these names have gotten annihilated.